Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to all the Trade Day team to the TGI. Thank God it's Friday, the 5th of September, Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. We'll go for our usual run through in here today. We'll take a look at the calendar, what we've had, what we've got coming up. We'll take a look at the macroeconomic, geopolitical, fundamental stories around the major news wires, what's influencing financial markets right here, right now, and then we'll dip into the reports on the charts to see where the key points are and which way markets are leaning going into today. So let's take a look at what we've got coming up, actually. So critically, all eyes on the payroll report, the employment report today, now in just under 1 hour. So in 58 and a half minutes time, we get the payroll report. Most eyes, as usual, are going to be on the non-farm payroll, the NFP part. So in here, expectations around 75,000 for that, as you can see here. But also watching out for average hourly earnings. We're going to be keeping an eye on the unemployment rate as well. So watching out for that today. That's going to be the big focus for today in just under 58 minutes. So keeping an eye on that going into today. That's going to be critical to the next leg. Having had a solid day yesterday, markets running up to all-time highs or at or near all-time highs and higher again this morning. A quick nod to the, in focusing on this throughout the week. Remember, we've got the Fed meeting in the middle of September, the 16th and 17th, with the announcement on the 17th. So 16th and 17th, a week and a half before that, we always go on the blackout period. So today is the last day of Fed speakers. So no Fed speakers in here between now and the announcement. So given that it's the payroll date today, we won't get any kind of reaction unless we get Fed speakers after the payroll date today. No reaction to the employment data today. We're looking now on the macro side, on the fundamentals with the Bloomberg Morning Briefing Americas. Nothing really of note in here apart from a potential $1 trillion pay package for Elon Musk. $1 trillion, but nothing really in here of talking about here about AI chips, but nothing really of note in here. The real thing in here is that we've seen in the last week or so really is so treasury markets have been really, normally what happens is the equity markets are what I like to say is the dog wagging the tail of a lot of the other markets, whether it's foreign exchange markets, bond markets, but equity markets are often very front and center. Some of the time, though, the bond market steps in and becomes more important. And bond markets certainly saw that. We certainly saw bond markets in charge over the last week and a half, 2 weeks, as yields globally have gone higher around concerns about global government debt. Not just US, we saw in China, in Japan, we saw in the UK, long bonds, so like 30-year maturity bonds, long bonds, 20-year, 30-year maturity bonds going to multi-year, multi-decade, in fact, high yields because of concerns about global debt, and US debt alongside that. 30-year Treasury bonds also going significantly higher. Remember, that's pushing up mortgage rates, that's pushing up long-term refinancing, and that's a reflection of the economy. Remember, the short-term debt, more a reflection of what the central bank stance is, which way the central bank, where interest rates are going. Longer-term debt, more a reflection on the economy. So we've seen bonds selling off, going to higher yields, and that's really then put a brake on and actually seen negative moves in the stock markets because of concerns around the economy reflected from the bond market. We've seen really a reversal of that in the last 24 to 38 hours, with bonds at the long end going up in price and down in yield, and that's put a relief to stocks and seen stocks move back up towards record highs. So the employment report is going to be important to that, to see if the economy is holding firm in the US, and if it is, the labour market holding firm, the economy holding firm, that could then help bond markets go back to higher prices, lower yields, and then also then assist stock markets going even higher to get new all-time highs. So really the reaction on the bond market is going to be important to this employment report today. What else do I have for you in here? So yeah, that's really reflected here. Look, stocks rise on rate cut optimism ahead of payrolls. Okay, then we've got morning briefing. All eyes on jobs data from Reuters. European stocks rise. Long dated deals. This was important. Long dated deals ease ahead of the US job data, and we'll come to look at that shortly. S&P 500 futures hit a record high. This was yesterday, and going high again this morning. Ahead of the payroll data. Broadcom surges. We touched on that earlier on as well. With the AI side of things. Treasury traders gear up for US payrolls to cement Fed bets. We'll come and look at that in a second. But basically, bond and currency traders are bracing for the US employment shows, to which stands as solidified views on Federal Reserve policy in terms of the near-term trajectory of interest rates. And also in here, we've got Bank of America in here saying that US bond route, so the bond route, that's the bond sell-off to higher yields, likely over in absence of an inflation shock. So as long as we don't get an inflation shock, this is from ex-colleague of mine, Michael. This is Michael Hartnett, great strategist. Used to work with Michael back in my days at Merrill Lynch / Bank of America, and he's basically saying dropping yields will drive unloved stocks such as small caps. So we're expecting a rebound in the bond market that's back to lower yields and should help stocks. So overnight, we've seen Asian equity markets benefit after the US stocks had a really solid day yesterday with those moves to higher prices and bonds and lower yields. So Nikkei followed suit overnight, up over 1%, and then Hang Seng nearly 1.5% higher. European exchanges only slightly higher. They already benefited yesterday, rallying yesterday with US stocks, but the FTSE nonetheless up. Just under 0.3. The DAX up just over 0.1, and the French CAC little change. And US stocks having had a really strong day yesterday, following through still higher this morning, with the S&P up 0.2 this morning and the Nasdaq overnight up 0.5%. Fed Watch tool now continuing to climb and pretty much nailing on now a rate cut at the September meeting. So 97% chance of a rate cut at the meeting that we have in just under 2 weeks' time. And if we go out to October now, we're kind of 50-50 between another rate cut or just one rate cut October. And then if we go then into December, now we're pretty much in here nailing on. So we've got now only 9% chance here that we don't have 2 rate cuts by the end of the year. So the market completely pricing into pretty much 2 rate cuts. And there's kind of 50-50 whether we get a third rate. Well, 60-40, 43% chance of a third rate cut. So potentially 3 rate cuts by the end of the year, market pricing in 2 rate cuts, and 50-50 whether we get the second rate cut in October. Potentially we get a bigger rate cut at the December meeting. But the market now completely pricing in the rate cut, 25 basis point rate cut, 0.25% rate cut at the September meeting. Here's the important chart in here. This is the bond yield. So from Wednesday through yesterday, yields, this is the 30-year bond. Remember, it ticked higher. We went up to 5%, reversed lower to lower yields on Wednesday and still lower yields yesterday. So back into the range. This is the 30-year long bond, and we're seeing similar price action on global bonds. And remember, as we say, Japan, UK bond yields went at the long end, went significantly higher to multi-decade highs, and they've reversed back to lower yields. 10-year actually moving to now at the bottom end of the yield range. So the 10-year actually breaking down to new low yields, not seen all the way back here since the end of April, and potentially moving into ground. We only went to this low yields in here after the tariffs back in the beginning of April in here, where that spiked to lower yields and then a reversal back to much higher yields through the bond market concern. So we're actually going to, arguably outside of this blip, this is kind of the low point we've been in here since all the way back since I think last year actually. Yes. So where are we here? Yeah, this is October last year. Okay. So apart from that blip, we're actually in 10 years going to, arguably multi-month in here, multi-month low yields outside of this blip that we saw around the tariff announcement back at the beginning of April. And on the 30-year, we were bearish in here at one point this week, but now flipping back bullish on the 30 years. And as you can see in here on the breaking above that peak yesterday up at 114.28, having been threatening a breakdown below 113.00 in here earlier in the week, completely reversing that through the second half of the week. So the 30-year now bullish, And we've stayed bullish the whole time on 10s, 5s, and 2s in here. You can see making new highs at the shorter end of the yield curve. On price, that's new high prices, lower yields, and that's an anticipation of a more dovish Fed. And on the stock side, obviously making going back up to new highs yesterday on the S&P 500 and making new highs in here on overnights, and Nasdaq not quite back up to the old highs, but nevertheless looking bullish within this kind of consolidation range and pointing to the top side. So stocks certainly carrying a bullish tone. Critical is going to be the reaction of the bond market through the employment report. So watching the bond markets, watching the 10 years, watching the 30 years bonds, and then watching the current highs on the S&P and this localized resistance, particularly in here, 2368, 23682 and a half, and then up at just above 24,000 here. On the Nasdaq, so potential upside breaks in here coming. I'm keeping an eye on that going into today. So all setting up kind of bullish, but it's all going to be critical on that employment report now coming up in just under 50 minutes now, 48, 49 minutes. It's all going to be about the employment report today. All right, guys. I'm going to wish you all a great trading day. Take care, stay safe. Have a great weekend too. And we'll be back with you with another Bull versus Bear webinar on Monday. Bye.